Welcome to this explainer. Today, we're diving into something super fascinating. We're going to trace the massive, sweeping forces of the global economy all the way down to the psychology of your very own wallet. I know it's incredibly easy to feel like global markets are this big, abstract thing, and our personal bank accounts are completely disconnected from them. But as we're about to see, they are intimately tied together by human behavior.
Here is our roadmap for today. We'll start with choices under absolute scarcity, then look at the evolution of inflation, how experience shapes worldviews, the psychology of real wealth, and finally, paying the psychological fee. Let's jump right in.
Kicking things off with Section 1, Choices under Absolute Scarcity.
So, when you hear the word economics, you probably think of math or crazy complex financial models, right? But actually, it's fundamentally the study of human choices when resources are limited. We're talking about scarcity. Our world simply doesn't have infinite resources, but man, we have seemingly infinite desires. Figuring out how to bridge that gap, that is the defining question of economics. I know it sounds super basic, but this one simple concept really is the foundation of literally everything we're looking at today. Every single financial decision you make sitting at your kitchen table and every massive multi-trillion-dollar shift in the global markets, they all trace right back to this reality. Because we can't have it all, we have to choose. And how we choose? Well, that's driven by factors largely out of our control. Which brings us perfectly to Section 2, the evolution of inflation. Let's look at how inflation has shifted over the past half-century, because it's wild. We start with a massive, highly volatile peak back in 1974, and then watch it drop all the way down to a historically low, stabilized level by 2017. Over a few decades, things like structural economic changes and better monetary policies basically calmed the storm. But let's zoom in on 1974 for a second, where global median inflation hit a staggering 16.6%. Just think about what that actually means for a moment. Under conditions of absolute scarcity, a 16.6% inflation rate violently distorts how humans make choices. Your money is rapidly evaporating in your pocket, creating this profound sense of panic and urgency. And why did it get so high? The data tells us these massive fluctuations are absolutely not random. They're driven by gigantic global forces. We're talking global demand shocks, supply shocks, and major oil price shocks. These are huge macroeconomic events that are 100% out of our individual control, yet they completely dictate the purchasing power of the cash in our wallets.
Moving right along to Section 3, How Experience Shapes Worldviews.
This contrast right here basically explains everything. Picture two investors. One was a teenager in the 1970s, watching their parents struggle through that brutal 16.6% inflation peak. Their worldview is forever anchored to the idea that markets are dangerous and highly volatile. Now, contrast them with a teenager from the 2000s, who came of age when global inflation was super stable, around 2.6%. You put them in the exact same market today, and they will have completely different emotional reactions to the exact same news, all because their financial foundations were built in entirely different economic realities.
Which leads to this remarkably comforting takeaway. No one is actually crazy. Seriously. When you see people making what looks like bizarre money choices, whether they're hoarding cash under a mattress or risking it all on speculative tech stocks, they're really just reacting to their deeply personal economic history. We all just do what makes sense to us based on what we've personally lived through.
I mean, check out this stunning reality. Your own experience in the markets represents roughly 1/400 millionth of total market experiences, but it makes up about 80% of how you think the market actually works. Think about that for a second. Your brain is using a microscopic fraction of global history to dictate your financial behavior. You're basically projecting your own little personal past onto the entire global future. All right, that takes us to Section 4, the psychology of real wealth. First things first, it is absolutely crucial that we separate the idea of being rich from being wealthy. Being rich? That's about high income and buying luxury stuff to look successful. It's super visible, but honestly, often temporary. Being wealthy, on the other hand, is all about what you don't see. It's not spending money you don't have. It's keeping your wealth hidden, practicing restraint, and wanting what you already have. Wealth is what actually endures. And because those global shocks we talked about earlier are totally out of our hands, your personal savings rate is the real secret weapon for surviving financial curveballs. You can't control your income completely, and you certainly can't control investment returns. The market's going to do what the market's going to do. But your savings rate, you are entirely in control of that. It is literally your shield against an unpredictable world. To protect that wealth, you want to use something called the barbell strategy. On one end of the barbell, you've got an optimistic stock portfolio for long-term growth, basically betting on human progress. But on the other end, you are completely paranoid, holding zero-risk cash and treasury bills, and you just calibrate the weight of each side perfectly so you can sleep well at night. Because if you don't balance that optimism with a healthy dose of paranoia, you can easily fall into the never enough trap. Warren Buffett put it perfectly when talking about a massive hedge fund collapse back in the late 90s. He said, to make money they didn't have and didn't need, they risked what they did have and did need, and that is just foolish. It's so true. That insatiable appetite for more will eventually push you right off a cliff of catastrophic risk.
And that brings us to our final part, Section 5, paying the psychological fee.
You have got to completely reframe how you look at market volatility. When the market tanks and your portfolio shrinks, yeah, it feels awful. But you have to view that emotional discomfort and uncertainty as the psychological fee for long-term wealth. It's not a fine for doing something wrong, it's simply the unavoidable price of admission. Nothing in life is free, especially financial freedom.
Now, paying this fee is incredibly tough because pessimism is just so seductive to us. As humans, we have an asymmetrical aversion to loss, meaning losing money psychologically hurts way more than making money feels good. Add in the fact that sudden, scary economic events grab all the global headlines, while human progress is relentless but super slow and hard to spot. Just understanding this bias prevents you from panicking, selling at the bottom, and essentially paying double the price.
So what's the ultimate defense against all this pessimism? You need to worship your room for error. This is the gap between what could happen out there in the crazy global economy and what you actually need to happen to maintain your life. By keeping a high savings rate and a paranoid cash reserve, you build yourself this vital buffer against those massive, unpredictable global shocks we started this whole conversation with. Because understanding the macro forces of scarcity and global inflation, that is only half the battle. The other half is entirely inside your own head. Recognizing how your lived experiences bias your choices is absolutely your greatest advantage. So the real question I want to leave you with today is this. Now that you know the true cost, are you prepared to pay the psychological fee of wealth? Thanks so much for joining me on this explainer, and I hope this helps you build a much more resilient financial future.